A few years ago, a woman received the kind of news she had been waiting for her entire career. After years of hard work, late nights, and constant pressure, she finally got a promotion. Her income increased significantly. For the first time in her life, she felt like she was getting ahead. She promised herself she would be smart with the money. She started watching investing videos, reading finance articles, following market news. Within weeks, she opened a brokerage account and began buying stocks. She felt confident, responsible, even proud. After all, she was investing now. She was doing what financially successful people were supposed to do. But there was one problem. She skipped several steps. She still had high-interest credit card debt. Her emergency savings were almost non-existent. A single unexpected expense could have wiped out her finances. And that's exactly what happened. A few months later, an emergency forced her to sell investments at the worst possible time. Some investments were down. Others had barely grown. She paid taxes and fees. The debt remained. The emergency fund was still missing. And suddenly, all the progress she thought she had made started unraveling. The mistake wasn't investing. The mistake was investing in the wrong order. This is one of the biggest misconceptions in personal finance. Most people spend enormous amounts of time asking what they should invest in. Stocks or ETFs, real estate or index funds, growth or dividends? But before asking what to invest in, there's a more important question. What should happen first? Because building wealth isn't just about making good financial decisions. It's about making them in the right sequence. The order matters. In fact, two people can earn the same income, save the same amount of money, and invest in the same assets, yet end up with dramatically different results simply because one followed the correct order and the other didn't. The truth is that investing is not the first step. It's one of the later steps, and understanding that can save you years of financial frustration. Most people imagine wealth building as a straight line. Earn money, invest money, become wealthy. Simple, but real life rarely works that way. Unexpected expenses happen. Jobs change. Markets fall. Emergencies appear without warning. And if your financial foundation is weak, even a good investment strategy can collapse under pressure. Think of building wealth like constructing a skyscraper. Everyone admires the upper floors, the beautiful views, the impressive height, the finished structure, but none of it matters if the foundation is weak. The taller the building becomes, the stronger the foundation must be. Wealth works exactly the same way. And that's why the smartest order to invest your money begins with something that many people consider boring. Step 1 is creating a starter emergency fund. This might not sound exciting. Why? Because emergencies are not rare events. They're normal events. A car repair isn't unusual. A medical expense isn't unusual. A temporary loss of income isn't unusual. The unusual thing is believing those events won't happen to you. Without emergency savings, every financial setback becomes a potential crisis. And crises force bad decisions. People take on expensive debt. They sell investments at the wrong time. They delay important financial goals. The emergency fund exists to protect your future from your present. Even a modest starter fund creates breathing room. It creates stability. And stability is the foundation upon which wealth is built. Once that foundation exists, the next step becomes clear. Step 2 is eliminating high-interest debt. This is where many people make a costly mistake. They become excited about investing while carrying debt that is quietly destroying their financial progress. Imagine earning 8% annually on investments while paying 25% interest on credit card debt. Mathematically, you're moving forward and backward at the same time. It's like trying to fill a bucket with water while a large hole drains the bottom. No matter how much effort you put in, progress remains limited. High-interest debt is one of the few financial obstacles that offers a guaranteed return when eliminated. Every dollar of interest you avoid is money that stays in your pocket. No market prediction required. No investment risk required. No luck required. This doesn't mean all debt is identical. A low-interest mortgage is different from high-interest consumer debt. But when interest rates become extremely high, paying off debt often becomes one of the best investments available. And this brings us to an important psychological principle. Many people want investing to feel exciting. They want quick wins, fast growth, big returns. But successful wealth building is often about removing obstacles before chasing opportunities. That's not exciting. It's effective. And effective is what creates results. After eliminating high-interest debt, most people are finally ready for step 3, building a full emergency fund. This is where financial resilience begins to take shape. A starter emergency fund helps. A fully funded emergency reserve transforms your financial life. For the first time, unexpected problems stop feeling catastrophic. You gain flexibility. You gain confidence. You gain options. And options are one of the greatest forms of wealth. Because financial freedom isn't just about having money. It's about having choices. The ability to handle setbacks without panic. The ability to make decisions without desperation. The ability to think long-term instead of constantly reacting to short-term emergencies. Once this safety net exists, investing can finally begin to occupy a larger role. But even here, the smartest order matters. Many employees overlook one of the most powerful opportunities available to them: an employer retirement match. Imagine someone offers to double part of your investment immediately. Most people would consider that an incredible opportunity. Yet millions of workers fail to take full advantage of employer matching programs every year. A retirement match is often one of the closest things you'll find to free money in personal finance. Before chasing complex investment strategies, capturing available matching contributions can provide an immediate boost to long-term wealth. The numbers reveal something surprising. The biggest driver of investment success isn't usually finding the perfect stock. It's consistently contributing money over long periods of time. That's why retirement accounts matter. They automate the process. They reduce emotional decision-making, and they encourage long-term behavior. But the real magic begins with the next step: investing consistently in broad, diversified assets. This is where many beginners become distracted. The financial world constantly promotes excitement. The next hot stock, the next breakthrough company, the next opportunity that promises extraordinary returns. The problem is that wealth is usually built through consistency, not excitement. History has repeatedly shown that broad market investing has rewarded patient investors over long periods. Not every year, not every month, but over decades. And decades are where wealth is built. This is one of the hardest lessons for new investors to accept, because slow success doesn't feel impressive. Yet slow success often becomes extraordinary success when given enough time. A person investing consistently for 20 years is usually in a stronger position than someone constantly searching for shortcuts. Because investing isn't a competition against other people. It's a partnership with time, and time rewards patience more than brilliance. This is where the difference between investing and wealth building becomes clear. Most people think investing is about choosing assets, stocks, real estate, businesses, funds, cryptocurrencies. But the truth is that investing is only one piece of a much larger system. The real goal isn't to own investments. The real goal is to build a financial life that can survive long enough for those investments to grow. And that's why the next step is often overlooked. Once you're consistently investing, focus on increasing your investment rate. Many people become obsessed with returns. They spend hours trying to earn an extra 1% or 2%. Meanwhile, they ignore something they can control directly: how much money they invest. Imagine two investors. The first earns incredible returns but contributes very little. The second earns average returns but invests consistently and increases contributions every year. Over time, the second investor often wins, because wealth is driven by both growth and contribution. And in the early years, contributions matter far more than most people realize. This is encouraging because contributions are largely under your control. You can't control markets. You can't control interest rates. You can't control economic cycles. But you can control how much of your income gets converted into assets. And that conversion process is where wealth is created. This is why increasing earning power remains important even after you begin investing. A promotion, a valuable skill, a side business, a better career opportunity. These things don't just increase income. They increase the amount of fuel available for wealth building. The mistake many people make is allowing lifestyle inflation to consume every raise. Income rises. Spending rises. Nothing changes. Years pass. The paycheck becomes larger, but wealth remains surprisingly small. The smartest investors avoid this trap. When income grows, they allow part of their lifestyle to improve, but they also direct a meaningful portion toward investments. This creates a powerful cycle. More income creates more investing. More investing creates more assets. More assets create more growth. And eventually, the process begins accelerating. This is where compounding starts becoming visible. In the beginning, investment growth feels slow, almost disappointing. You contribute thousands of dollars and see relatively modest gains. It can feel like all the effort isn't worth it. But compounding isn't designed to impress you early. It's designed to reward you later. The first years are often driven by your contributions. The later years are increasingly driven by growth. And one day, many investors experience a surprising moment. Their investments generate more growth in a year than they contributed themselves. That's when they truly understand the power of compounding. Because wealth eventually reaches a stage where money begins working harder than you do. But reaching that stage requires patience. It requires consistency. And it requires avoiding unnecessary mistakes. One of the biggest mistakes is constantly changing strategies. Investors often become impatient. A market declines. They panic. A new trend appears. They chase it. A different strategy becomes popular. They switch again. This behavior creates a cycle of buying high and selling low. Ironically, the people who spend the most time reacting to the market often achieve the weakest long-term results. Not because they're unintelligent, because they're allowing emotions to control decisions. Successful investing is often less about intelligence and more about behavior. The ability to remain calm. The ability to remain consistent. History shows that markets experience corrections, crashes, and periods of fear. Yet history also shows that patient investors who remain disciplined have often been rewarded over long periods. The challenge is that long periods feel very long when you're living through them. That's why systems matter. Automation matters. Consistency matters. The less your emotions participate in routine investing decisions, the better. And eventually, as your assets grow, diversification becomes increasingly important. At first, simplicity is often enough. But larger portfolios require greater attention to risk management. Different asset classes, different account types, different sources of growth. The purpose isn't complexity. The purpose is resilience. Because protecting wealth becomes just as important as building it. This brings us back to the original question. What is the smartest order to invest your money? Build a starter emergency fund. Eliminate high-interest debt. Create a full emergency fund. Capture employer matching opportunities. Invest consistently in diversified assets. Increase your investment rate over time. Continue growing income while controlling lifestyle inflation. Diversify intelligently as wealth grows. Notice something important. The order begins with protection, not investing. Protection first, growth second. Because wealth is easier to build when setbacks cannot destroy progress. And that's the lesson many people learn too late. They search for the perfect investment before building the foundation that allows investing to succeed. But the strongest financial plans aren't built on excitement. They're built on stability. The smartest investors understand something that beginners often miss. Getting rich slowly may not sound exciting, but it has created more wealth than almost any shortcut ever promised. In the end, building wealth isn't about finding a secret investment. It's about following the right sequence long enough for the process to work. Because the smartest order to invest your money isn't just a list of financial steps. It's a blueprint for turning income into freedom. And the sooner you follow that order, the sooner your money starts working toward a future that becomes bigger than your next paycheck.